Hi, and welcome. You're listening to the X22 Report. My name is David. This is episode 1616A, and today's date is July 16th, 2018, and the title of the episode is An Unprecedented Wage Stagnation Hits as IMF Warns of Economic Downturn. Now, before I get started, I just want to make an announcement. I uploaded 2 interviews over the weekend, one on Saturday, one on Sunday. The first one is with Peter Schiff. The second one is with David Quintieri. So if you go over to YouTube and you type in X22 Report Spotlight, you will see both of the interviews right on YouTube, or you can come over to the X22Report.com or newsentinel.com, scroll down a little bit, look over the right-hand side, you'll see the interview there. You can play it right on the site, or you can go to Steemit, that is steemit.com/@X22Report, and you can see both of the interviews right on Steemit, and you can play the interviews right there. Let's get into the economic collapse financial news. Now, we understand that the central bank and the patriots, they're both going to try to create a narrative of why this economy is coming down. And we know the central banks, they're going to pull out all the tricks to make sure that they have the control. And this means we're going to see it in the corporate media. This means we're going to see it in the data that is coming out of the government. This means we're seeing it out of many different areas, the Fed and everywhere else, because they need to control what is about to happen. And of course, as we know, the elections will be coming up within 2 years, so they have to show at this point on, moving forward, that this entire system is coming down because they need their people in the system to keep everything the way they want it, in control, pushing us into a new system. And what we see is the economy continually breaking down. Actually, the Umich sentiment, well, that has slumped to a 6-month low, and we see already that what they're reporting on is that many people, they're very worried about the tariffs and what's going to happen in the economy because of the tariffs. And of course, what's been happening here is the mainstream media, they've been putting this type of report out there that, as what the Fed has said, the tariffs might wreck the economy. We know the Wall Street Journal has been saying that there might be a recession before 2020. We know that the New York Post is out there saying the economy is not doing as well as everyone thinks or Trump thinks. And we know, because we've been following the economy, and this is why we've been following this, so we understand what is happening, how this was going to flow, and it's flowing pretty much the way we thought it was going to happen. And we see the establishment, the central bank, they're creating this narrative, and this is going to become worse before it gets a lot better, because they're going to really push it now as time moves on. And we're going to see a lot more articles and a lot more stories coming out on how the economy is starting to fall apart. We do have a new report, and this is coming from the OECD countries, and this is the Organization for Economic Cooperation and Development. And in this new report, we see that they're warning that there's a problem with wage stagnation. And we see that what it says is they're warning that positive employment trends are at risk of being derailed by unprecedented wage stagflation, which is going to affect the low-paid workers. The OECD Employment Outlook for 2018 stated that the employment rate in developed economies averaged around 61.7% at the end of 2017, the highest level since the global financial crisis. The employment rate is expected to reach 62.1% by the end of this year and 62.5% by late 2019. That is, if trade wars and quantitative tightening do not trigger a global slowdown. Now, it's very interesting that they said either a trade war or quantitative tightening. And what they're reporting on here is there's a slowdown in wage growth, and they've listed all the countries where this is happening: Canada, France, United Kingdom, United States, Germany, Japan, Spain, Australia. Now, the report stressed income inequality has widened to unprecedented levels, which has developed into major structural issues for OECD economies. Wage stagnation affects low-paid workers much more than those at the top. Real labor incomes of the top 1% of earners have increased much faster than those of poor and middle class in recent years. And this is what happens at the end stage of a central bank system. Everything starts to break down. All the wealth is filtered up to the top because they're getting prepared for this entire system to come down. Now, in June, the OECD released a report titled Inequalities in Household Wealth Across OECD Countries, which examined the distribution of household wealth across 28 countries, and it discovered that America, guess what, is the number one in the world for financial inequality. About 10% of the American households own 79% of all the wealth in the country, while the poor and the middle class, which is about 60% of American households, only owns 2.4% of the country's wealth. And this is really what happens when you have a central bank running the country. You can print like crazy, and the system is coming to the very, very end. Remember, in the beginning of the system, in the 70s, what do we have? We had a lot of currency that was being created. We had inflation, where people saw their salaries move up, housing prices moved up, everything moved up, but there were very high interest rates to make it feel like the economy was just booming. But actually, it was the beginning stage of the end, where the economy was set up to die. And what we're seeing right now is that we're at the end stage of all of this. And this is why we're seeing all this wealth inequality. This is why wages are stagnated. This is why interest rates are very low. If you really think about it, everything that happened in the 70s when we came off the gold standard, everything is now the opposite. That's how you know that things are rapidly falling apart. Now, applications for mortgages for new homes, and we talked about real estate quite a bit. We know that real estate is declining. We know it's declining in Canada. We know it's declining in Australia. We know it's declining in Europe. We know it's declining in the US. And we have proof of this because application for mortgages for new home purchases fell by 8.8% in June compared with May, and we're down 12% compared with May of 2018, according to the Mortgage Banker Association. Now, this is very interesting because during the spring and summer months for real estate, this is the big boom for real estate. People love to purchase. People go out. They want to be in their house before school starts. It's warm. They can move. Everything looks great. And when we start to see things like this, you need to get worried because things are rapidly breaking down. And we know that there are countries out there that are moving out of the dollar. They're de-dollarizing. And we know this is Russia. We know this is China and many other countries. And we see an independent Chinese refiner. They have suspended crude oil purchases from the United States and has now turned to Iran as one of its sources of crude. And the reason why this is all happening is because, as we know, there are sanctions on Iran. There are tariff penalties on China. China is turning around and placing penalties on the U.S., and they decided this would be their penalty to go and purchase the crude oil from Iran instead of the United States. Now, the IMF, they have come out with a lot of different warnings. They also said they needed a rainy day fund for the European countries just in case there's some type of economic shock. And they started to explain that the economic shock could come from trade wars or something else that might occur, maybe the Brexit. And of course, what is happening here is they realize that the system can't stay afloat, and they're using the excuse of the Brexit, using the excuse of trade wars, of why all of a sudden the economy might come down. After many, many years of telling us how strong the economy is, they're telling us that the economy might buckle under its own weight because of tariffs, penalties on certain products, where we're looking to get a percentage on the products coming into the country. The Brexit, where they wanted to leave the EU, which is really not happening at this point in time. And they're trying to make excuses of why the economy might be imploding. But we know, because we've been following the economy, most of the numbers, they are manipulated. What they've been telling us all along, and we reported on this many, many times before, where the IMF predicted the GDP growth where, it's 4 or 5%, and it's always wrong. It always gets readjusted, and it's around 2%. It's always around 2.3%, maybe 1.8%, and it's always completely off on what they always say. Now, the IMF right now, they are warning that amid rising tensions over international trade, the broad global expansion that began roughly 2 years ago, it has plateaued and has become less balanced. Now remember, the central bank, they have the control over trade. Remember, they created a centralized organization. This was done on purpose. Now, the IMF still expects tax cuts to lift U.S. economic growth to 2.9% this year. Well, is it really going to be 2.9%? Most likely not. Yes, they'll do some manipulation. They'll revise the numbers. They'll make it look good. But it's not going to really get that high. And we know what they do. They'll go back in time and they'll lower that number to make the new number look a lot better. Now, the IMF reiterated its warning about the damage from a trade war, saying that the outlook is more fragile and under threat. And the IMF is cutting projections for the euro area, Germany, France, and the UK. They're saying after weak weather-related events in the first quarter, lowered the outlook for Japan, and they're making all different types of excuses of why the global outlook does not look that great. And we know the real reason why the global outlook does not look that great, because it was never great in the first place. It was completely manipulated. We know the banks are completely insolvent. We know all these stress tests and everything that the central banks have been doing. They've just been creating this illusion to make us think that things are going well. So what we see happening right now is that the IMF, the biz, the mainstream media, all these different organizations, they're warning us and they're telegraphing and projecting out of, how bad it's going to get. They're warning us right now, laying the breadcrumbs, letting us know that things are going to get worse as time goes on. And what they're doing is they're laying this out to blame this on the tariffs, to blame this on what the economic policies are. And they're going to try to create this narrative, to create this illusion, just like they did in the 70s, where they said, oh, it's gold speculators. This is why we have to come off the gold standard. But we know that this is all fake, phony, and false. We know exactly what they're doing. This is why we've been following this. We've been following the economy all this time because we knew eventually what they were going to do is they were going to try to blame this on an entity, a country, a person. It didn't make a difference. And they were going to try to escape the blame for all of this. And we were following them to show everyone that the economy was really never doing well. The economy was created to make it look like it was doing well. But in the background, just like prior to 2008, the economy was declining rapidly. The economy was not doing well. The subprime securities were not AAA. And everything was falling apart. Now what we've been following is how they created this illusion to make it look like it's doing a lot better than it really is. But we know a lot of the corporations have a lot of debt. We know they manipulate their books. We know the banks manipulate their books. We know that the banks are completely insolvent. We know the biz is calling the banks out on this, saying that they're using tricks like Lehman because they're trying to separate themselves from this entire thing to say that, hey, we had nothing to do with this. We're up here, all these individuals, low-level banks and all this, they're the ones who created this, not us. We warned you. See, we're good. And that's what they're trying to do. And we see that they're trying to create this narrative that it's going to be someone else's fault. And of course, with the biz, blaming it on the banks, the Fed, the mainstream media, blaming it on the policies, they can turn this thing and try to create a narrative and separate themselves from what is happening here. But we know what's happening here. We know that they're the ones to blame. We know it's the central bank. We know what they've been planning and what they're trying to do. And what they're doing right now is that they're very worried that their system might be destroyed, that they might be the ones that everyone blames when everything starts to fall apart. But one thing is for sure, we know the system's coming apart. We know it cannot be sustained this way. We know that when we look at real estate, when we look at GDP, when we look at the employment numbers, when we look at all these different numbers, we know exactly what's going on. And we can see it in other parts of the economy. I mean, look at all the indicators. Look what the Fed is trying to hide. They're trying to hide all the data. They're trying to change the data. So they're not to blame. But they are to blame. And this is why they're trying to hide all this, to say it never existed. Because they're just going to wipe everything off. They're just going to completely make it disappear. And no one will be able to understand what is going on. They'll tell us what is going on, but that's not what's really going on. And this is why we've been recording all this. This is why we've been tracking all this. This is why we can go back in time and say, no, you discontinued this. The indicator was showing us a recession. The yield curve was showing us a recession. This indicator was showing us a recession. We can point all of this out. We have a record now. It's there in time. They can't erase this record. So you need to be prepared and ready because we are headed towards a major transition. And for many, it's not going to be easy, but for those who are preparing, it will be a lot easier. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.